Guys.
Good morning to those of you joining us today. I am Becky McDicken with the Pennsylvania Department of Banking and Securities. We've got just a few minutes before noon here, so just hang tight, grab a beverage, whatever you need to do, but we'll be starting in just a few minutes. Thanks. Good afternoon, everyone. Thank you for joining us this afternoon. We're going to wait just another minute or so for people to get signed in through Teams, and we'll get going in just another minute.
I had to minimize for a moment.
All right, I think we're going to get started. Hopefully, a few more people will be signing on as I do the normal spiel. But good afternoon. I'm Becky McDicken with the Pennsylvania Department of Banking and Securities. If you're here today, you're going to hear all about loans and understanding that essential financial product from the Consumer Finance Protection Bureau, otherwise known as the CFPB, from Washington, D.C. Today, next slide, sorry, thank you. We are bringing this series of webinars to you because of a grant that PA Treasury received, and we've been working with them for the last year. We got the grant funds in September of 2020. That is being administered by the National Association for State Treasurers Foundation, the Center for State and Local Government Excellence, and the International Public Management Association for Human Resources, and a lot of generous support from the Wells Fargo Foundation. Next. You should have received this postcard recently. OA sent them out to all state employees, and this was allowing people to see the OA website on financial wellness. That's the first thing, first line on there in the blue box, but taking some steps to improve your financial health. So if you didn't see this, obviously it's up now. You can always contact OA to, I believe there's more of this information on their website. Next. And as we move forward, we're continuing with the monthly webinars and creating new video content for OA's financial wellness site. We are doing every second Tuesday and third Thursday at noon. These are also recorded so that you can watch them back at a more convenient time if noon is not good for your schedule. We have a couple of upcoming topics, and I do want to note one date change. In August, we are still doing Avoiding Scams and Identity Theft. That will be the Attorney General's office. In September, the Department of Insurance will be doing insurance overview for us. And then we're skipping October due to other rollouts of programs going on. So we've moved FAFSA and FIA, the Pennsylvania Higher Education Assistance Agency. They're moving to November. But keep paying attention to other upcoming webinars. We are going to be continuing these even as the grant funds run out. So pay attention for the employee bulletin board announcements. And now, moving forward, today we're being joined by Ken McDonald and Irene Skricky from the CFPB, as I mentioned. Ken has been with them since 2013 and works with doing outreach to other government agencies, financial education people. I'm not using my words very well right now. I apologize. And he does outreach to build partnerships. Irene has been with the CFPB since 2011, and she is going to make us more familiar with loan products and terminology today. So I'm going to turn it over to the two of you now. Thank you.
Thank you, Becky. First of all, I'd like to thank all of you for attending today and hope you'll find this presentation very useful. I'd like to start off with a standard disclaimer that this presentation is being made by a Consumer Financial Protection Bureau representative on behalf of the Bureau. It does not contain legal interpretation, guidance, or advice of the CFPB. Any opinions or views stated by Irene and I are the presenter's own and may not represent the Bureau's views. So for today's agenda, we're going to go into what is the CFPB for those who may not be familiar with us. We're going to show you some data points of consumer financial knowledge and complaints from the Commonwealth of Pennsylvania. And then at that point, I will be turning it over to my colleague Irene, where she will go over the basics, the definitions of loan terms. She'll be using an example of financing an automobile to explain these loan terms. She'll then illustrate some of the CFPB resources we have to help consumers understand loans. She will display how loans affect your credit history. And finally, on managing debt and credit during the pandemic, some additional resources that the Bureau has curated specifically for managing in the pandemic. So CFPB, here our mission, we see ourselves as a 21st century agency. We opened up our doors in July of 2011, so literally that is true. That helps consumer finance markets work by making rules more effective, by consistently and fairly enforcing those rules, and by empowering consumers to take more control over their economic lives. And it is that last component, empowering consumers to take more control over their economic lives, is what Irene and I do, particularly at the Bureau. So one of the things that we are very proud of here at the Bureau is we want to hear from individuals. So if you are experiencing a problem with a credit card company, a problem with your checking account or your savings account, a student loan, mortgage, auto loan, we want to hear from you. And so you can submit a complaint to the CFPB. And you see here where that orange arrow is pointing down to, that is our homepage. And you'll see up in the upper right-hand corner in blue, submit a complaint. You can click on that submit a complaint and will take you into the process. You can submit a complaint online. Unfortunately, only English speakers are currently available to submit a complaint online. But that said, you see the orange arrows pointing to a toll-free number up there in the upper right-hand corner above submit a complaint. Call into that number. If English is your second language or you don't speak English at all, we can take complaints in up to 180 different languages. And to give you how that works, say you're going to call up and Spanish is the language that you predominantly using, feel more comfortable using, call up the number and just say Spanish, please. And within 30 seconds, you will be connected to a person who speaks Spanish fluently. And for that part, they will take all of your information and start the submitting a complaint process. We do see here, we do a lab where all of our website can be translated into Spanish. You'll see periodically on every page, you see with the lower orange arrows pointing to translate it back and forth between Spanish and English. So we'll have available in Spanish and English what the process is like, but to be able to submit the complaint online, it needs to be done in English. What I'd like to do now is go over some consumer financial knowledge and complaints in Pennsylvania to kind of give you guys an idea of where Pennsylvania stands with regards to the rest of the country. And so one here is, why is financial education important? And this is from a study by the FINRA Investor Education Foundation. And FINRA stands for the Financial Industry Regulatory Authority. It is a self-regulating entity of the financial services industry and governs a lot of the rules and procedures that financial advisors must follow. And so their Investor Education Foundation, since 2009, has been conducting a survey every 3 years on national financial capability. And in that survey, they ask 5 questions covering aspects of economics and finance encountered in everyday lives. And so the chart here is showing you the percentage of individuals who answered 3 or fewer questions correctly, Pennsylvania versus the US. Pennsylvania is in blue, the US is in orange. And you'll see, except for 2012, Pennsylvania has outranked the US when it comes to these questions. So unfortunately, that's not a positive thing. That shows more people in Pennsylvania answered fewer of the questions. And the other unfortunate thing is we see from 2012 to 2018, that percentage is rising. So what this is telling us is that Irene and I and Becky and Tim all have our work carved out for us, and that we need to do more help, more ways to get assistance to folks in Pennsylvania and the US. So another part from that same survey is the percentage of individuals who have a rainy day fund. And you'll see that from 2009 to 2018, it's gone up pretty well from 37% in Pennsylvania to 47%, with a slight dip from 2015. That could be reflective of people having to pull some money out of their rainy day fund. So positive in the upward trend of having a rainy day fund, but still below 50% of individuals report having one. And one of the reasons why we look particularly at this, we have done research on financial well-being, defining financial well-being. And one of the things that we have discovered is that those individuals who have a rainy day fund have a higher score than those who do not have a rainy day fund within our financial well-being scale. And one of the things we discovered is that having a rainy day fund shows an individual who is practiced in setting money aside, thinking about their future, and aware of their consequences that could happen to their immediacy. So it is a very good indicator of someone's financial well-being. Now here we pulled out some stats that we thought might be an interest to you guys. So we were asked to go through our complaint database, and you saw earlier where we can submit a complaint to the CFPB. We track all of those and put it into a database that is made available to the public. All PII and other identifying information is screened out, but basic data on the types of complaints that are coming through, we do put into this database. So I did a run off it from January 1, 2021 through April 30, 2021. And we had 10,101 complaints coming from the Commonwealth of Pennsylvania in that time period. And the overwhelming majority of those were on credit reporting. 76% of the complaints came on that. The second one was on debt collection. So the credit reporting was a lot of times an individual seeing an error and they were having difficulties getting that error removed from their credit report. Then we went into another source from the Urban Institute that was looking at various types of loans and debts across the country. The link down at the bottom of the slide will take you to the data set. And if you're a map geek like me, it's really cool. It pulls up a map. You can zero into Pennsylvania and pull out the county that you live in Pennsylvania that will give you the results specific for your county. But overall, we wanted to look at adults with debt and collection. Says that's one of the more stressing elements for individuals. And we have found that the percentage of adults in Pennsylvania overall who have some kind of debt in collection that was 26%, slightly lower than the US, but still about 1 in 4 individuals in Pennsylvania has some debt in collection, with the median amount of $1,795. Now, the other point I wanted to put in here with the student loan debt is you'll see it's significantly lower, both for Pennsylvania and the US, but the dollar amounts were significantly higher. And so for those individuals, they may be a smaller percentage of them. It is a much bigger burden for them to have to manage. So it's one of the things that we want to watch out for, and also highlights the need for you guys to come to the November FAFSA webinar that will be coming up in November of this year, being sponsored by the Commonwealth. And another medical debt, you see 12% in Pennsylvania, but 15% in the United States as a whole. This is another issue that does present to cause individuals problems. Not only is it a debt, but you're probably facing a medical issue as well. So it can be a double whammy for you. So with that said, setting the stage, I wish to turn this on over to Irene. Irene?
Great. Well, thank you, Ken, for all that background information and some interesting data on Pennsylvania. I am Irene Skricky. I'm also with the CFPB. We're a federal agency, and both Ken and I, as was said earlier, are on the consumer-facing side of the Bureau, trying to help consumers in managing their financial lives. And so I'll be going over some of these kind of loan terms and examples. But I want to start out with something. Ken also mentioned financial well-being, which was a study we did looking at how people what people do to kind of improve their financial well-being and what seems to work for them. Ken mentioned some financial education facts, but we found that in addition to what you know, it's actually more important that you know what to do and how to find information about financial topics. And we call that financial skill. So it's one of the biggest predictors of financial well-being for individuals. And what financial skill is knowing how to find reliable information. So you don't need to know everything. You just need to know how to go find it. And know what reliable sources are. And I would note the CFPB with our federal and unbiased information is a great reliable source. Then understanding it, knowing how to make sense of it. Does it make sense for you? Does it apply to your situation? And then knowing how to use it, how to actually execute decisions, make decisions and make things happen as a result. And so a lot of what we'll talk about today are, in some sense, elements of financial skill. You don't need to know all the details of a mortgage or whatever, but you need to know enough to figure out where to get the right information, and then you can make your decision. So we thought that just mentioning financial skill might be an interesting way to kind of kick off this part of the webinar. So next slide, Ken. What I'm going to do now is I'm going to walk through some basic loan terms. Now, for some of you, this will be completely familiar, but it's always good to have a kind of a baseline. And you may have friends, family, neighbors, others who maybe this information isn't familiar to, so you may want to be in a position to share that. And then we'll go into some examples. So next slide. These are kind of the basics. Again, probably most of you have heard of these or know what they are, but and actually, before I start, I'll say one other thing. There are essentially two types of of loans. One is called installment loans, and that's when you're buying a thing like a house, a car, technically a student loan. You're buying an education, and then there are and there you have a fixed payment every month over a certain amount of time. For the other type is revolving loans, so that's like credit cards, right? There's not a fixed. It's not one thing you're buying, you're using it in lots of different ways. And the payment will vary based on whether you pay in full or just pay a portion. It'll vary month to month depending on what you bought that month. So there are some examples of revolving loans. We'll talk a little bit more about installment loans today, but most of these things we talk about would apply in certain ways to revolving loans as well. So just wanted that as background. So again, here, if you're buying a thing, if it's an installment loan, the principal is the amount you're going to pay back, the amount you're borrowing. Interest rate, again, most of you know this, which actually should just say interest rate, not an auto loans interest rate, but that's the cost of the cost you agree to pay to borrow that money expressed as a percentage. So mortgage rates are these days are on 3 or 4%. Auto loans may be higher. It does not include fees charged for the loan. And then the loan term or the duration is the length of time you have the loan, usually months or years. Mortgages are typically 30 years. Car loans typically used to be typically 5 years or 60 months, if my math is correct. And those three things together, those three essential things, the principal, the interest rate, and the loan term, determine the monthly payment. So there's a mathematical relationship between those, and it's very important because changing any one of the three will change your monthly payment. But it's important to think about more than just a monthly payment because your total cost may be different depending on some of these factors. So to follow up on that, next slide, Ken. Here's some additional kind of things to know about. Again, probably familiar with the down payment, but that's what you put up front, money you've already saved, typically to reduce the amount you have to borrow. The less you borrow, the less you pay over the life of the loan. Again, another thing you may have heard of, but a cosigner, often parent, close family member, or friend who agrees to pay back the loan if you don't. They sign the loan documents too. And that can be sometimes a way for people to get access to a loan if the other person has a better credit score. But always remember, the other person is also on tap for the loan. So if you have a friend or family member ask you to co-sign, just remember that it's not just a favor you're doing them to sign something. You will actually be held accountable and it will affect your credit score if they don't pay. So I want to make sure people kind of understand that. Just quick definition of negative equity or being upside down is when you buy something like a house or car and the value of that drops below the amount you still have to pay back. If you were to try to sell that item, home, car, something like that, you would actually have to pay money to get rid of it because you actually owe more than it's worth. That was a bigger issue, say back in the Great Recession, but sometimes it happens with cars, for example, where they depreciate a lot when they come off the lot, and your loan may, for a while, be more than the car is worth. And then the last thing I'll mention here, total cost. We'll talk more about that in a minute. This is really important because you can have a lower or higher monthly payment based on the size of the interest or the length of the loan. But the best way to really compare loans is through total cost, or one very good way to, not the only, but a very important way to compare different loan options you might have is by looking at the total cost of that loan over the life of the loan. And we'll say a little bit more about that later. And then I just have one more definition slide. This is the big word slide. This is the advanced slide. I just wanted to mention these. Amortization, it's a cool word, if you're at a party and you just want to drop the term amortization, people will be like, ooh, you're smart. That's just the process of paying off a loan. When you get an installment loan, this is not true, of course, for a revolving loan because it's not a fixed thing, but with a installment loan, as you pay the loan off, you're paying off both principal and interest. And typically you pay off more principal with the money you borrowed first and the interest. You pay off more interest first. It's exactly backwards. And over time, more of the principal. So just something to kind of be aware of. This one, annual percentage rate, I think it was at least 5 years. I was at the Bureau at least 5 years before I finally possibly understood what annual percentage rate is. you may hear the term APR, like in car loan. If you hear ads for car loans or home loans or things, what APR is. APR is basically just the interest rate, which we already discussed, the kind of what you're paying to borrow the money, plus any additional fees getting rolled into the interest rate. So your APR will always be higher than the regular interest rate because it could be the same if there are no fees. But if there are fees like an application fee or other types of fees, those get they can be added into the interest rate just to give you a sense of the total cost. So a little confusing, but it can help you potentially compare loans because it will be including those other costs in it. And then the last thing I'll just mention is there is a requirement for most types of loans. It's a federal requirement that the Bureau, as a federal agency, actually oversees, mandates that you get the Truth in Lending Act form, or TILA, as we call it fondly, that requires that you as a borrower get written disclosures about some of the terms of the credit, interest rate, and some other things, that you have to get that disclosure form. And you may know that we all often click through disclosures because, it's a lot of work to read them. But the TILA form is really valuable. You are required to get it, and it can be something that'll help you better understand loans that you're getting and comparing loans. It's sometimes hard to use it to compare loans because you often don't get it till you're close to closing a loan. Really, ideally, you would get it sooner, but it is an important disclosure that you should get anytime you borrow money. Okay, so that's a bunch of terms. Let's walk through an example. And again, a lot of this will be familiar, but I think what's important is the way we encourage you to think about loans is to think about comparing them based on total cost. So one of the things that is true, I think, for homes and cars, and I guess arguably for college education too, is that in some research we've done with consumers, people are more excited about shopping for the home or the car than they are shopping for the loan, right? It's fun to look at houses, look at cars, think about what you want. And then after the fact, you may look for financing, but it's very important to shop for the financing with the same care, because otherwise you may end up paying too much, especially if they're bundled together, as they can be, for example, when buying a car. So we did some research specifically on auto lending. So on the next slide, after learning about people doing this, we developed a set of education kind of goals to really encourage people to shop for a loan. And again, this would apply for other products as well, to shop for the loan with as much care as they shop for the vehicle. And in fact, to shop for the loan before, so that you have financing in place or close to in place and have a better sense of what you can afford before you start going out and falling in love with a car or a house or I guess a college. And then the most important point is to look beyond the monthly payment. Monthly payment matters. You have to be able to afford it month to month, but to use the total cost, because what often happens is the monthly payment can be made lower by doing things like extending the loan for a longer duration, a longer time. And while that makes the monthly payment lower, it makes the total amount you pay more. And so you want to make sure you understand, if you choose to do that you'll be paying more in the long run. And then lastly, we have a lot of materials on our website to really, for cars and for other purchases as well, to help you understand potential situations and financing features that could lead to surprises later, costly surprises. So for example, we encourage you to fully understand, do you want add-ons like for cars, for example, gap insurance and credit protection and the much joked about extended warranties that we all seem to get phone calls about, but that you sort of understand those things so that you don't just say, yeah, sure, I'll take that, that you know what you're paying for and if it makes sense for you. So again, these suggestions, while I'm framing them around auto loans, will work for other types of loans as well. So next slide. Everything that I am telling you is on our website. And this, I know this is hard to see, but just to show you kind of a screenshot, we have a set of auto loan materials called Taking Control of Your Auto Loan. And we have similar materials for other financing purchases. But again, a little hard to see, but there are some actions we suggest you take. First, plan to shop for your loan. So figure out your budget and understanding things like maintenance costs and other things in the case of cars and homes too, I guess, that you would want to make sure you're budgeted for. Then explore the loan choices and try to actually get financing ahead of time, because then that will help you determine what to purchase. Understanding what's negotiable. In the case of auto loans, a lot of things are negotiable, not just the price. And then understanding how to close the deal. So there's similar materials on other products on the same process of kind of, this is again financial skill, right? You're looking at your budget, you're making the financing, shopping for financing, and then comparing loans and getting up the deal that's best for you. So to dive a little deeper, next slide, thank you. Again, we'll go in a little closer so you can see better, but we have, as part of that Take Control of Your Auto Loan set of materials, we have a Comparing Auto Loans worksheet, which will help you to do this total cost comparison. We have similar tools, somewhat similar for other products like homes, but I'm going to show you this one because I had worked on it and I'm very fond of it. So this is the front and back. So on the next slide, we'll dive into the top section of this. So the idea is that you would try to use this sheet to compare different loan options. And I say try because sometimes it's hard to get all the loan terms if you're working with, say, an auto dealer. It's easier maybe if you get financing ahead of time to actually understand the different choices. But here's where, if you just, as an example, in the left column, the other two are for you to fill in, is obviously the price of the vehicle, and the little orange circle indicates something's negotiable. And of course, prices for auto loans are negotiable. So make sure you may be able to get that price lower. There's additional features. This is what I mentioned a minute ago, the add-ons, things like gap insurance and other things that and features of the car too that you may want to add on. You can kind of put the price in for those, and again, those can be negotiated. Some costs that you will incur are not negotiable, like say state and local taxes and state registration fees. And as state employees, I'm sure you would not appreciate a consumer coming in and trying to negotiate over fees charged by the state. So those are fixed, but you can research what those are. And then there's some other negotiable fees in the case of cars. So you add all that up and you get, this is the total cost of what you're going to buy, because you're adding in those additional charges like taxes and title fees. So the next chunk of the worksheet, now we're going to drop down to the lower half, is now you got to figure out how much of that you need to borrow. And of course, what you do is you figure out what can I put down as a down payment, and because that will come off of the amount you need to borrow. And also, if you have a trade-in, I guess similar idea would be if you were selling in the home area, if you were selling a house, you could, some of that, any equity you had could go into your next loan. But in the case of a car, it's trade-in. And there are options we suggest you can sell your trade-in separately from bringing it to the dealer. That may give you more leverage on price. But anyways, you take the value of the trade-in and the down payment and you subtract it from the total price, right? Again, that sort of makes sense. You don't need to borrow that money because you already have that. So now you know what you need to finance. In the case of the example, it's $15,800. And you go on to, I know this feels like a math exercise, but don't focus on the numbers as much as the bigger concepts. We're all having maybe flashbacks to middle school right now. My teenage kids do their homework, their math homework, and I'm like, oh my God, I couldn't do any of that anymore. But that's why you don't need to know how to do it. You don't need to know the facts. You need to know how to find the information, and hopefully this will help. So then you figure, okay, now I have to borrow a certain amount of money. What is the interest rate for a particular loan? What's the length of time that you'll have the loan, and what's the monthly payment? And here's where this shows it for a 4-year loan at a 3.5% interest rate. You could look at what it would cost if you did a 5-year loan or a 6-year loan, because those are available, and at the same interest rate, you would see that the monthly payment would drop. So that's interesting. Your total cost will be higher. We'll get to that in a second. So here you could, again, use this to put in different options that you might get from a bank or credit union, from a dealer, and just play around and see what difference it makes to lengthen or shorten a loan or change the interest rate. You get different monthly payments, but then this is the very last, the lower half, the next slide, please, the lower half of the back of the worksheet. This is the important part. When you do those numbers, you'll find out what the total cost of your purchase is. So what it's doing is it's adding in the cost of the interest. So what was a $20,000 car, if you remember that was the price on the first page, has become almost a $23,000 car because of the interest. You've paid $1,155 in interest in this example. If you had other loan examples, you could see whether you're paying more in interest and paying more over time for a different loan. And so, again, you have to be able to afford your monthly payment, but this might help you realize that, hey, the dealer offered me a 4-year loan and a 6-year loan. The 6-year loan had a lower monthly payment, but hey, I'm actually going to pay a lot more. And so maybe the better choice is the shorter loan. It depends, but at least now you have the information to make that decision. So that's the way you kind of want to think about it, is figuring out your financing, figuring out the best options, even before you go in, hopefully for the purchase of the item, be it home, car. And I know it's more complicated in practice sometimes, but that's the idea. So I showed you just the front page of the Take Control of Your Auto Loan section that has all the stuff I just showed you and more, lots more details that you can get there. There's a lot of information on that page. If you are looking for information on other types of loans, we have that too. So I'll just run you through some of those other resources. So next slide, Ken. We do have a whole section on buying a home, on mortgages. And it's the same idea where there's a number of drop downs. You can't see it all here. This just gives you a quick visual, but there are sections on, what you do before you even start shopping, how you figure out the budgeting, what are the different types of home loans, the different terms, like there's 15-year loans and there's 30-year loans and there's different sources of loans. And then there's a lot of information too on how closing loans, what information you'll get, what's required from the lender. So this can help you navigate that whole buying a house process. Similarly, next slide, we have a paying for college section. Similar, has a whole bunch of different information, including places where you can find out what kind of loan if you already have a loan, student loan, if you have student debt, if you have a federal or a private student loan, and what some different repayment options are. There's both a understanding your financial aid and student loans section, as you sort of see. Again, it's a little small on your screen probably, but sadly, the more trafficked part of the site is the repaying your student loans, because so many people have student debt. And there you can learn about things like income-based repayment, public service loan forgiveness, and other programs that may be out there, and some information about some of the kind of COVID loan forbearances and things like that. And so then we also have those student loans. So next slide, please. We have a page on credit cards, another type of loan, this revolving in this case. And there's where you can see, just for example, you can see there's lots of, again, tiny letters, but key terms like APR, annual percentage rate, but also information and sort of simple plain language and unbiased definitions for balance transfers, credit balances, daily periodic rate, a whole bunch of other things that will help you kind of navigate the credit card world, both getting a credit card and then managing one that you have. We have similar pages on some other financial products too, besides just the ones I've showed you, but this just gives you kind of a flavor. So now we'll turn to the next topic, which is the intersection between loans, either loans you already have or loans you may be interested in applying for, and your credit history. And obviously, that's a very strong.
Irene?
Yes. Sorry.
Hi, Irene. Sorry, before you move into this next topic, we did have one question that came in. Wonder if you could address it quickly.
Absolutely.
The question is, do you have something similarly helpful in terms of worksheets that work for smartphone deals, such as Verizon, T-Mobile, other types of providers? The person who asked the question is wondering if they increase their fees on loans for phone purchases.
So we don't. We don't have direct. It's FCC, the Federal Communications Commission, that oversees assorted terms and conditions and things related to cell phones. I think you could use some of the same ideas about trying to understand the different terms and the different implications, but we do not have any content on that because it's not really it isn't within our sort of legal jurisdiction in a way. Ken, do you have anything you would want to add to that?
Well, I would follow up with the FCC to see if they have any kind of checklist for that of what to look for. But I also agree with you, Irene, using the framework that you identified with the example of the auto loan and walking through what the different fees are. The best way to probably do this would be comparing different phone cost options and looking at what the different fees are that are being added on to those different options, and then using the same kind of methodology that was developed with the auto loans to see what your overall costs are going to be.
Right, but the short answer is we don't have such a worksheet because we don't for phones specifically, just because that's not really within our. There's a financial side to it, of course, but we don't have we don't work on the actual phone side of it. so to speak. But that's a great question. Thank you for that. All right, I will carry on. And Tim, yeah, absolutely interrupt. I thought I heard you trying to get in there, but I'm a pretty steady stream talking here, so just yell next time. So we'll just turn a little bit to credit now. That's actually the issue I work on most at the Bureau, is access to credit and building a credit history. I think everyone, again, probably knows there's an intersection between credit and loans, because loan information is what helps create your credit report. And your credit report helps you to get loans. So it's a kind of a circular thing. So again, probably familiar, though people often get credit reports and credit scores mixed up. Credit report is a statement that has information about all of your kind of credit activity, your repayment, your amount of access to credit you have in terms of amount of limits on a credit card, or the size of your mortgage loan, things like that is all goes into the credit report, which is a listing of all of that each of the big three credit bureaus, TransUnion, Experian, and Equifax have. There's also some specialty credit bureaus that have different mixes of information. There's actually quite a few of those, some focusing on housing or banking or employment. We won't talk about those today, but they do pull on some of the same information. That information, and then those companies or others, people that buy that data from them, create a credit score. So that's the number. Everyone knows, do you have a 710 or a 680 or whatever? That number is built on what's inside the credit report. So they're different but related. People tend to like the credit score just because it's nice to have one number, right? It's so straightforward, a single number, but it's complicated. It's always important to also check your credit report, because there could be errors and issues that you would learn from the credit report that the score alone won't always tell you. And where does that information come from? Well, it is your bank use, your credit union use. It's basically everyone who has lending data with you and certain other types of data, or most of them, will report to the credit reporting companies. And then if you want to get a loan and you go to your bank or your credit card issuer or an auto lender, they will check and see what data is there. Now you can imagine, since it is very circular, how do you get it in the first place? You can't get a loan without a credit score, and you can't get a credit score without a loan, right? That's an interesting question. And for those who don't have a credit score, there are some tips and ideas that we'll share. We'll share one product in particular that can help. But as you also probably know, the most important way to have a good credit score is to, if you have loans, is to repay them, repay on time, keep the amount of credit you're using. Don't use more than, if you can, a third of your credit limit. If you have a credit limit of $5,000, try not to go over, what's a third of that? About $1,500. This is where my middle school math is shaky at this point in my life. So there's lots more to say about credit. We won't get into it, but Ken, if we go to the next slide, I think our next thing is credit visibility. As I was mentioning, how do you get into the credit system in the first place? There are quite a few people who are not, and we did a study a few years ago about what we call credit invisibility. So how many people don't have any kind of credit record or credit score? And the short answer is that people who have no credit record, they just don't appear at all. And that's typically any young person, right? Everybody enters at some point. Everybody has no credit score at some point until they enter adulthood and get a first credit card or a student loan or somehow enter the credit system. So it's about 11% of the population, the adult population, that has no credit record at all. They just don't. They may use all cash, or they may just be young, or they may have stopped using credit. And then there's another 8 to 9% that have had a credit record, but it can't be scored. So there's not enough information, called insufficient history. So you haven't had credit for long enough. Again, possibly a young person or someone who's just new to the credit system, or it's stale. I find that a funny term. They had credit, but it was a while ago. So, maybe they finished paying off their mortgage, or they once had a credit card and closed it. So they have a history, they have a credit record, but there's not enough information for the credit bureau to score you. So if you add those numbers up, about 1 in 5 U.S. adults, which is about 45 million people, 20% of the population, does not have a credit score. And that can be a real barrier. They can face higher costs for borrowing, clearly, or not be able to borrow. But it also can be an issue for housing and employment, because to get an apartment, to rent an apartment, to get a job, many jobs will actually do a credit check. And so how can people move from invisibility to visibility? And so we're just going to quickly share there's a number of ways to do it, but Ken, next slide. We did a study of credit building loans as a way to build credit. And a credit building loan is a very interesting little product. We looked at one in a credit union in St. Louis, but they're available from different places. There's some online ones as well. But essentially, it's almost a no-risk loan. The lender puts the money it's going to lend you, and these are typically small, $600 to $1,000. They put it into a savings account, but they don't actually give it to you right away. So you don't just get that money and you can go off and spend it. They put it in a savings account. When you pay each month, that money gets released to you. So you sort of pay them $50 and they give you $50. So then you have that money. So if you don't pay it, you don't get the money, but so you're not in debt and the lender still has the money. But if you do pay it, it gets reported to credit reporting agencies. So it minimizes the risk, again, because the money doesn't come to you. And you're doing it to build credit. You're not doing it because you need that money or you would get a different kind of loan. And it can be a stepping stone to other products. You could build a credit score by doing that. So we looked at one of these loans. Next slide. I'll just quickly share the results. We looked at one and did a study of people who got the loan and people who were offered the loan but had to wait for it. And it was, again, a $600 loan plus $48 in interest, so 12 monthly payments of $54 each was reported. And then we actually tracked people's credit and savings for a year and a half later to see the difference between those who took the loan and those who wanted to but had to wait for it, basically. That's a true rigorous study. And the findings were that it was actually quite effective, but not for everyone. It was very effective for people who didn't have existing loans, who were not overextended, who sort of were true credit invisible. For those people, it increased the likelihood of having a score. Most of them were invisible already, increased the likelihood of having a score by 24%. And for the few that did have a score already but didn't have many other loans, it increased their score by 60 points. So that's pretty big. And also because some of the money people got from those loans, as it was released to them, they kept it instead of spending it. On average, they had increased savings because they saved some of that money, which is a great outcome as well. But we did find that for people who had a lot of other debt and had bad credit, and they said, oh, I'll get this loan to fix my credit, it was essentially one more obligation they had to pay. And in some cases, they missed payments or they didn't pay their other loans in order to pay this loan, but not paying any loan is going to harm your credit, right? It doesn't matter which one you pay or don't pay. If you don't pay loans, you're going to get a ding on your credit. And so for some of those folks, they ended up the same or potentially even slightly worse off in terms of a slightly lower credit score. So all that to say, this is a tool you can use, but just understand that if you get it, you got to pay it back, right? And also it might be a better option for someone who's truly just entering the credit system for the first time and doesn't have other debt. So that's and then I think the next slide, just so you know, we have lots of information on credit reports and scores. This is just a screenshot of a few of our resources, such as information on how to check your credit report. It says once a year. You can actually do it more often right now because of COVID. How to build credit from scratch, things like credit building loans, how to rebuild your credit if you have bad credit, how to dispute errors on your credit report. You can find all that on our website. And the pretty orange booklet, I'm just going to show one slide on that. Next slide. This is a little booklet called Want Credit to Work for You. And it has cute animals, and you can't be unhappy about cute animals because it's more engaging. Each of the tools has a little animal, but this has a number of very simple, easy to use. They're paper tools, but things that some of them actually been turned into digital tools now too, but information on and little worksheets on how do I get a copy of my credit report? Here's how to do it. You can write down the dates you want to do it. How do I check for errors? There's a checklist of possible errors. You can write down the errors. How do I dispute them? How do I improve my credit? So this booklet is something you can order or see the online version of it, and it may be useful for those of you who want to further explore the debt and credit relationship. All right, and then the very last topic, this will just take me a couple minutes, and then we'll have some time for questions. We are hopefully coming out of the COVID era, the pandemic, but many people are still affected by it. I mean, I'm hoping that most of the people on this call are state employees and therefore hopefully did not lose your jobs. but you may have been affected, a spouse may have been affected, you may have friends, families, and neighbors. So, and you may just have financial struggles generally. So there are some protections and some things to think about in terms of managing money during time of pandemic. And so I'll just share this with you quickly. We have a homepage, the coronavirus resource homepage, that looks something like this. It may have changed a little bit with new videos and things, but that is on our website. And if you dive into that on the next slide, there is one section on dealing with debt. So if you're having trouble paying back debt because of it being impacted by, again, job loss or other issues related to COVID. And then on the next slide, there's also one on credit, protecting your credit during the coronavirus pandemic. And I'm just going to walk through the list of steps that is recommended or that's you can think about if this applies to you, or again, you can share this information with others. So on the next page, this is sort of just a distillation of what's on that. And this is true for just debt issues in general, is that if you're having trouble paying your bills, you're worried about credit reporting, is to, find who your lender is, be it the credit card, mortgage, whatever. Look at the lender's website to see if there's hardship or relief programs available. Some of those I think are still in effect. Some were before. There were federal forbearance. There's forbearance things, meaning you can get a break on your mortgage for a period of time if you've been affected. And then call that lender and find out, what's available, ask questions about it, understand how it will be reported to credit reporting agencies. And in particular, find out what you need to do when the relief period ends, particularly in the case of mortgage forbearance. You can get a 6-month forbearance. At the end of it, you can extend it for another 6 months, but you have to call and ask. You have to initiate that. Basically, you have to take some action. Most of these things, with the exception of student loan forbearance, is not automatic. You have to reach out and tell the lender you're having a problem. And this is true even if it's not around COVID. Lenders will often work with you around repayment plans or other types of accommodations, but you've got to take a step. And so once you sort out if that makes sense for you and you understand it and you agree to it, if you can get that agreement in writing, comply with the agreement. And then on the next page, getting to the credit piece, next slide that is to check your credit reports to see that they actually accurately reflect the agreement. Sometimes it doesn't get reported correctly, and sometimes it takes a little bit of time. So there may be a delay of a couple months or more before the creditor actually updates the records with the credit reporting agency. So you may want to give it a little bit of time, but then check and make sure that if you agreed for a lower payment and you're following that and they report you as delinquent, they're not allowed to do that. The CARES Act does not allow that. So you can complain. And here's the fun fact. Separate from anything to do with COVID, through next April of 2022, you can now get your credit report free weekly. It's always been true you could get one copy a year annually, an annual copy, but right now you can do it weekly through the 3 nationwide credit reporting agencies, TransUnion, Equifax, Experian. If you go to annualcreditreport.com, that's the portal to do that. Don't go to other websites, they may charge you. This is the federally mandated free site. And you can check, if you really are into credit and want to check every week, you can do that for free for the next almost year, actually a little less than a year now. And then dispute any errors that you might see. And so that's, again, because of some of the special COVID protections, these are the things you can do. But these general ideas will apply regardless, actually, whether there's special protections or not, is to really keep an eye on your credit, make sure there's not errors, make sure that any special accommodations you've gotten from lenders get correctly reported. And I think that may be my last slide. Yes. So that's what we wanted to tell you about, and would be very happy to answer questions and any other follow-up issues you might have.
Irene, I'd like to bring up one other point with the coronavirus, student loans. Now, before the coronavirus, you were not allowed to make a additional payment to the principal on your student loan like you can do with a mortgage. During the coronavirus, with the forbearance for your student loans, if you had the ability, you could make additional payments to the principal of your student loan to help pay that down faster. I know my niece took advantage of that opportunity. So I'd like to stress to you, if you do have the financial ability to do it, it might be a really good idea if you're facing the student loan debt to pay that principal down faster. and I believe that was extended through September 30, 2021. But our website has the date for that.
Right. Yeah. So any of you who had federal student loans, at some point you didn't have to pay them. It was an automatic forbearance for student loans, but that will end at some point. You'll have to pay again. And as Ken said, if you continued to pay during the forbearance time, you actually were essentially paying extra in a sense on the loan, which is always a good thing to do because it'll get you, get that loan paid off sooner. Thank you for sharing that, Ken.
You're welcome.
And before we switch over to Tim to see if there's any questions, I just want to point out as well that the Department of Banking and Securities, we have a 1-800 number here in Pennsylvania, 1-800-PA-BANKS. If you are having problems with a mortgage issue, with a lender, you can contact us and we may be able to help, especially in this era of COVID. So please know that's why we're part of this process, is we do have resources to help Pennsylvania consumers. Obviously, also, there's a lot of information on OA's financial wellness website, which again, we've put that slide up. And then just having mentioned student loans, if you need any assistance there, contact PHEAA, PHEAA.org. They actually have new products out to help you consolidate loans. They know that what's going on with COVID as well. So that may be another option if a student loan debt is an issue for you. So I just throw those resources out there. And now I'll see what Tim has for us.
Great. Thank you, Becky. That's very helpful. In looking at the Q&A, there were no further questions that were added, so we don't have any questions right now. It's not too late. If people in the audience do have questions, go ahead and submit it. We'll definitely take a look and let the presenters respond to the question. Just as go ahead.
I'd like to actually highlight something here. Currently on the screen, you're seeing the slide of the steps you can take to improve your financial health provided by the state. Look at step number 2. For any of you who've been taking in all this information that Irene has been giving us and you want to be able to figure out, okay, how does this apply to my particular situation? I have an auto loan, I have a student loan, or I have a mortgage, and how does this information I have, how can I improve those conditions? Step number 2 there. The state is providing for you as in the state employee assistance program. Call that 800 number and talk to a consultant with a credentialed legal advisor and financial consultants that can talk you through how this might pertain to your particular situation.
Great. Thank you for that highlight. Much appreciated, Ken. Still no questions. And so if we don't have any, I suppose we can sign off if anybody doesn't have any other, if none of the presenters have any other questions or comments that they'd like to chime in before signing off.
No, it was very much a pleasure to be with everyone. Someday we'll be together in person, I hope, and can do some of these events in person. Now, I think we're all tired of looking at screens, but it was great to be able to share this, and we are happy to encourage you to look at our website, look at all the different resources, and let us know if there's anything else that we can do for any of the participants.
Thank you so much, Ken and Irene. We really appreciate your time both for today and last week's session. So thank you. And I guess we're signing off for today. So thank everybody. If anyone has any follow-up, you can always reach out to me, Becky McDicken. I'm in CWAPA under Banking and Securities, so feel free.
Great. Thank you. Thanks, Becky. Thanks, Tim.
Thanks, everybody.
Bye-bye.
Bye-bye.
Bye.